3 weeks before Lehman Brothers collapsed, someone made a bet worth $400 million that the stock would fall. Not a modest hedge, not a cautious rebalancing, a surgical strike placed in the options market with a precision that still makes regulators uncomfortable. When the crash came, that bet printed money. The rest of the world lost their homes. And here's the thing nobody talks about. This pattern repeats every single time. Before the dot-com collapse, before 2008, before the COVID crash, before every major market implosion in modern history, large amounts of money start moving in strange ways, quietly, methodically, weeks or months before the headlines arrive. By the time you hear about the crisis, the exits are already full. So how does this work? Who sees it coming? And why does no one ever seem to warn the rest of us? Let us start with a simple truth that will reframe everything you think you know about markets. The stock market is not a single game. It is 2 games happening on the same board with completely different rules. In one game, you have retail investors, people with brokerage accounts, checking their portfolios between meetings, buying shares of companies they believe in or heard about on social media. They react to news. They follow trends. They buy when things feel good and panic when things feel bad. In the other game, you have institutions. Pension funds, hedge funds, sovereign wealth funds, family offices managing generational wealth. These players manage money in quantities that defy comprehension. A single institutional trade can move a stock 5% before lunch. And here is the critical asymmetry. Institutions do not react to the market. They anticipate it. They have access to research you will never see. They have relationships with executives, central bankers, and policymakers. They have teams of analysts working around the clock, modeling scenarios that most people have never considered. When they move, they do not make noise. They make arrangements. This is where the story of pre-crash money movement begins. Picture a cruise ship, a massive vessel carrying thousands of passengers across calm waters. The band is playing. People are drinking champagne on the upper decks. Everything feels fine. Now imagine that the crew knows there is an iceberg ahead, not the passengers, just the crew. What do you think happens? The crew does not run screaming through the corridors. That would cause panic. Instead, they quietly move toward the lifeboats. They position themselves near the exits. They tell their families to grab their valuables. And they do all of this with a smile while the party continues. By the time the passengers feel the ship lurch, the lifeboats are already half full. This is what institutional money does before crash. It does not announce itself. It repositions slowly and deliberately while the rest of the market keeps dancing. So how do you see this happening? There are signals, not obvious ones, but they exist if you know where to look. The first signal is the bond market. Specifically, what happens when institutional investors start moving money out of stocks and into government bonds? This creates a phenomenon called yield compression. Long-term treasury yields fall because there is suddenly massive demand for safe assets. When the 10-year yield drops sharply while the stock market is still hitting new highs, something is wrong. The two are telling different stories. In July of 2007, 6 months before the Great Recession officially began, institutional money flooded into treasuries at a pace not seen in decades. The stock market did not peak until October. Retail investors kept buying all summer. They did not see what the bond market was screaming. The second signal is options activity, specifically unusual put volume. A put option is a bet that a stock will fall. Normally, there is a balance between puts and calls in any given market. But before major crashes, something shifts. Put volume on major indices spikes, often weeks before the actual decline. The days leading up to the 2008 collapse saw put activity in financial stocks that was statistically anomalous, not slightly elevated. Anomalous. The kind of activity that should happen once every 10,000 days. It happened exactly when it mattered most. The third signal is insider behavior. And I do not mean the illegal kind. I mean perfectly legal, publicly disclosed selling by executives and board members. Before every major crash in the last 20 years, corporate insiders across multiple sectors began selling at elevated rates. This data is available. The SEC requires it to be filed. And yet, almost no one looks at it until after the fact. In 2021, insiders at major tech companies sold more stock than any year in history, billions of dollars week after week, while those same executives told the public to stay bullish. The correction came 6 months later. By then, the insiders had already cashed out. Now, let me show you the uncomfortable math. Imagine a hypothetical crash. The market falls 30% over 3 months. A severe correction, but not unprecedented. It happened in 2020. It happened in 2008. It happened in 2000. In this scenario, institutional money that repositioned before the crash loses perhaps 5 to 10%. They moved early. They hedged. They rotated into defensive positions. The fall hurts, but it does not devastate. Retail money, which tend to stay fully invested until the fear becomes unbearable, loses the full 30%, often more, because retail investors panic sell to bottom, locking in maximum losses right before recovery begins. But here's the part that stings. After the crash, prices are low. Institutional money, which preserved capital and now has liquidity, starts buying. They acquire beaten-down assets at a discount. Good companies, real estate, distressed debt, all on sale. By the time retail investors emotionally recover and start buying again, prices have already rebounded 20, sometimes 30%. This is the wealth transfer. It happens in plain sight every single cycle. It is not a conspiracy. It is a structural feature of how markets function when information and capital are unevenly distributed. The people who see it coming build generational wealth. The people who do not rebuild their savings from scratch. And yet, the financial media tells a different story. Go back and watch the coverage from early 2008. The phrase soft landing appeared hundreds of times. Analysts on major networks assured viewers that the subprime problem was contained, that the fundamentals were strong, that there was nothing to worry about. Meanwhile, the smart money was already gone. This disconnect is not accidental. Media narratives run on access. Analysts who scare viewers do not get invited back. Pessimism does not generate clicks when the market is up, and so the coverage stays optimistic right until it becomes catastrophic. The same pattern repeated in 2021 and 2022. Inflation was transitory until it was not. The Fed had everything under control until they did not. The market was resilient until 40% of the NASDAQ evaporated. Every time, the public narrative lagged the private repositioning by months. So what does this mean for the bigger picture? It means the market has a timing problem. And it is getting worse. The tools that institutions use to anticipate moves are becoming more sophisticated. Algorithmic trading, satellite data, real-time transaction monitoring, alternative data sources that did not exist 10 years ago. The information edge is growing, not shrinking. Meanwhile, retail participation has exploded. More people than ever are in the market through brokerage apps, retirement accounts, and passive index funds. They have more exposure than any previous generation and less visibility into what is actually happening beneath the surface. This creates a system that is structurally fragile. When things are good, everyone profits. When things turn, the exits are not wide enough. The people with early information get out. The rest get crushed. And here is the quiet irony. The very act of institutional money exiting can trigger the crash it was trying to avoid. When enough capital starts moving toward the exits, it creates selling pressure. That pressure accelerates. Price drops trigger margin calls. Margin calls force more selling. The whole thing cascades. So the people who see the crash coming sometimes cause it precisely by trying to escape it. We are left with a question that does not have a clean answer. If this pattern is visible in hindsight every single time, why does it keep working? Why do retail investors keep getting caught on the wrong side? Part of it is access. The signals are there, but finding them requires time, expertise, and tools that most people do not have. Part of it is psychology. Believing that the market will continue rising is comfortable. Looking for evidence that it might not is uncomfortable, and so we do not look. Part of it is incentives. Financial advisors, fund managers, and media personalities all benefit when people stay invested. No one gets paid to say wait, or be careful, or this looks wrong. And part of it is simply the nature of a system that was never designed to be fair. Markets do not exist to distribute wealth equally. They exist to allocate capital efficiently. And efficiency in this context means rewarding those with the best information. Somewhere right now, someone is looking at data you will never see. They are watching money flow through systems most people do not know exist. They are calculating probabilities, modeling scenarios, and making quiet moves that will not show up in headlines for weeks or months. Maybe they see something coming. Maybe they do not. There is no way for you to know. But there is something you can know. This pattern has repeated for as long as markets have existed. The next crash will come. The money will move before it does. And by the time everyone understands what is happening, the best seats will already be taken. The only question left is where you will be sitting when the music stops.